So you, the person watching this video, need to understand that currently we are in the middle of a very unique moment where we are about to be blessed with another bull run. And I want to go ahead and talk about why we are likely to see the market to continue pushing up. Now, yes, I am drinking a Capri Sun, not sponsored. These were on sale. You got to buy things when they're on sale, right? Just like stocks, you want to buy them when they're undervalued. You want to buy everything undervalued, right? But with that said, let's go ahead and talk about what we're currently seeing. Now, Bank of America recently shared this chart highlighting how institutional clients are currently buying tech in a way that we haven't seen since pretty much a long time, right? They're pretty much saying that, look, the asset managers, the people, these institutional investors, they are buying tech by the dozen, right? They're pouring a lot of capital. And why is this important? Well, one of the things I mentioned in previous videos, you could watch my previous videos, I don't delete them. I mentioned how, according to FINRA, institutions are estimated to account for as much as 70% of stock trading volume. And so, in other words, you want to pay attention to what the institutional investors are doing, because guess what? They are the ones that move the market, right? You don't want to pay attention to what your Uncle Jerry is doing, right? You want to pay attention to what the big money that moves the market is actually doing. Now, I know I shared this chart in my last video, so forgive me if you've seen this already, but I want to highlight this again. By the way, this chart is from JP Morgan, and it shows how pretty much hedge funds are participating heavily currently, right? And what it shows is that hedge funds are going heavy long and also going heavy short. And so why this is important is because hedge funds, right, just like in their name, they hedge. So when they're going long, sometimes they go short. Now they're going short almost as much as they're going long. And so what this means is that if the market continues to push up, well, they're going to probably, slow down on their bets going downwards that are hedging. And that's going to cause what you should probably have heard of before, a short squeeze, right? And I know this may sound a bit confusing if you're not used to how hedge funds participate in the market, but essentially hedge funds are buying a lot, going long, meaning they're very bullish, but they're also a bit cautious, so they're shorting in other names. And the way that they're shorting is almost as aggressive as how long they're going. But if the market keeps pushing up, they're going to want to close those shorts, which means that they have to buy more, and it pushes prices up further. And again, that is pretty bullish, and that's the reason why I wanted to share this chart again. So forgive me if you saw it before, right? I shared this for those that are insiders within the Push and Profit Research Group, but I wanted to share it again on this public video because I think it's pretty notable to see how aggressive institutions are, and to really just talk about this potential of this short squeeze. But don't take the information that I'm saying for face value. Look at what the market is actually doing. When we take a look at the NASDAQ, right, the triple Qs, QQQ, we see that it's at all-time highs. So the market right now, the NASDAQ is a little bit more tech heavy. It's at all-time highs. Now, yeah, today it actually fell down, but we're still up higher than the day prior, and that's pretty bullish. Now, when we're at all-time high, or all-time highs, I want to correct myself, what we end up seeing is more participation, right? Because now people start to get FOMO, right? We just saw that institutional buyers, right, were getting FOMO, right? They're buying at paces that they have not done for a while. But once we're at all-time highs, well, then we have more participants jumping in because they're foaming at the mouth, right? They're seeing the market at all-time highs. You're like, okay, I gotta jump in now, right? It's just the typical psychology that we often see. And oftentimes I caution it when things are overextended, but currently I think that we still have room to run. Now, I also want to share this right here, which gives us a bit of insight into the market internals, right? So what we're seeing here is that we're currently seeing leadership pretty strong. We're seeing that there's more new highs than new lows within the last couple of trading sessions. And again, this is kind of one of the market internals that you want to pay attention to. This is leadership, right? And if you don't know what this is, by the way, I talk about this for free within the institutional trading playbook. It's going to be the link in the description of this video. I'll also pin it down below. It's completely free. So if you're like, Justin, I kind of don't get what you're saying, I have a video that's completely free that will break it down. It's actually a series of videos to talk about how to, look at the market from an institutional lens. So definitely check that out. But what we're seeing is that leadership is pretty up there. It's pretty strong. And in addition to that, we're also seeing broad participation within the market. For example, if we take a look at this relative rotation graph, we see that a majority of the sectors are transitioning to either the improving quadrant or the leading quadrant. So we're seeing that there's strength in a ton of different sectors, and that's pretty bullish, right? You want to see the market go up with the overall, almost all the sectors going up as well. Now, if the market's going up and it's just one sector, right, that's not really showing strength, right? If the market's going up and the reason it's going up is because, utility stocks are going up, it's kind of weak. But when the market's going up and everything is going up, well, that shows a lot of strength. Now, recently we had this published from an analyst at JP Morgan stating that US stocks will make fresh new highs this year thanks to tech investments. Now, this analyst says that they had this strong expectation for stocks to just go higher this year with the economy and consumers remaining resilient amid policy uncertainty. And they attribute it to, and this is pretty interesting, I'm actually going to read the quote. He says, "We believe the path of least resistance to new highs will be supported by technology/artificial intelligence-led strong fundamentals, a steady bid from systematic strategies, and flows from active investors on dips." And so to really boil down what this analyst is saying is that the fundamentals are pretty strong and robust, or I guess that's redundant. They're pretty robust, and that's simply because of the investments in artificial intelligence. Now, I know when, AI was coming out, everyone was like, oh, this is a fad, right? This is just, Fugazi, it's Fugazi, right? But the reality is a ton of companies are improving their margins because they're implementing AI. They're becoming more efficient in some way or another, right? Regardless if it's their customer service and they're using customer service to use AI to make them more efficient on calls, so be it, right? They're investing in several different pieces of their infrastructure and embedding AI, and that's supporting businesses, these companies, to continue to have that strong growth. So that's pretty bullish. Now, quick plug, because I don't mention it a lot, I am on X, formerly known as Twitter, and I'm very active there. So make sure if you are on X or on Twitter to check me out, right? You could just, give me a follow and check out the things I say there, because I'm trying to be more active on X. I actually find it very interesting. There's a lot of great people on X. It's not just me, myself, or I. There's so many great thought leaders. And so if you are on Twitter and X, just give me a follow. And also, if you haven't done so already, make sure to hit that like button for this video. I completely forget all the time to recommend that or suggest that or kind of say that, because I just forget, right? But it really does help out with the YouTube channel. So make sure to hit that like button, subscribe if you found any value. And with that said, I want to talk about what's the next catalyst that we want to look forward to going next, right? And that's why I want to go ahead and pull up this week, which is going to be on Friday, June 27th. We get the PCE report, which is a report that is an inflationary gauge that the Fed prefers. And we're going to want to monitor this because it's going to give us insight of, are we closer to having rate cuts happen, right? Are rates cuts coming in September, or is it gonna be delayed, right? This is gonna kind of give us more insight. So definitely we're gonna wanna pay attention to what happens Friday. Now, before you guys go, make sure to check out this video right over here where I talk about asymmetrical risk. It's a quick video. It's literally 1 minute. Make sure to check out that video, and I'll see you guys on that next video. Take care, guys.